Joining us now for more on the markets, Mohamed El-Erian, professor at the Wharton School and Allianz chief economist. Mohamed, always great to see you.
Thanks for having me.
So, I mean, if you take a look at the bond market, the cues there seem to be shifting to a concern about growth, concern about longer inflation. Where do you stand on all of this?
So I do think we're going from a price shock to a price shock and a demand shock. And that's the economic logic of all these tipping points that are being triggered in the war. I must say I'm more worried than the average. I'm more worried than the average because of the dynamics of the war. It's an asymmetrical war. You have 3 parties, now 4 parties, all of whom believe they're winning, which makes it very hard to end this war. And the U.S. is the only one that can declare victory but can't impose outcomes. And I also look at the economy, and I'm starting to see demand destruction that can accumulate. And if you go to Asia, they're not just worried about higher oil prices. They're worried about actual physical shortages.
Right.
And that is another tipping point for the global economy. So in general, I've gone from reduced risk to maximum risk off to now a few names look attractive, but I would not be going into the market and buying the index at this juncture. When
you talk about demand destruction, Asia is talking about shortages. Demand destruction is happening elsewhere outside of the United States. We might be a long ways off from demand destruction. So how insulated can our economy remain, even if elsewhere in the world there is sort of this greater impact?
So we win in relative terms under virtually any war scenarios.
But relative terms don't mean that much to the average consumer or to the markets, maybe.
Right. But so the question is in absolute terms. I think there's no doubt that we are going to have not just an energy price shock. In my mind, we're going to have an inflation shock. Secondly, we are likely to see that inflation shock translate into less spending, particularly for the lower income households. So there will be a demand effect. If this continues, so you start with energy shock, interest rate shock, broader inflation shock, demand shock, then if this continues, which I hope it won't, we're going to be talking about financial instability. So that's the sequence. Hopefully we don't go all the way down, but that's the sequence that's been triggered by this war.
$200 barrel in oil. Amongst energy watchers, that had always been sort of the outlier scenario, but that outlier scenario seems to be moving a little bit closer and closer as this conflict continues, particularly because every day the war goes on, there's an increased chance that there's going to be terrible damage to infrastructure, which would create this longer shock to happen. So how do you think about that in terms of what that would be? Would that be the systemic shock that you're talking about? Would it have to be that dramatic?
So the first tipping point happened at the end of the second week when we went from disruption to damage. Damage means the tail is much longer.
Yeah.
And you heard Qatar come out and say 17% of its LNG exports have now been disrupted for 3 to 5 years.
Yeah.
There's also been damage in UAE, less so, but there's been damage, and there's also been damage in Saudi, less so, but there's been damage. So that's the first tipping point. The second tipping point is when we started seeing attacks on other infrastructure. So aluminium was an example over the weekend. That has resulted in a 6% increase in price. And we are starting to realize it's not just about oil. It's about fertilizers. It's about helium. It's about aluminum. There's a whole list of things. So I do worry that we are going to go to a broader shock. But the next tipping point economically is actual physical shortages. If we start seeing that in Asia, that will impact the U.S. So the U.S. will now import higher products in terms of prices. And the question is, do we now see also a disruption in the availability of products?
So in terms of what markets are not pricing in, do you think that last week at CERAWeek, a number of executives, including Mike Wirth of Chevron, had said that the oil markets are not pricing in what is going on in terms of the disruption to energy. Are we not pricing things in equities? Are we not pricing things in energy, in the bond market? Where do you go?
So you heard earlier, there's a massive differential between the physical price of oil right now in Asia, 140, 150, and futures.
Sure.
Okay, at some point, you need convergence to happen. Equity, we still have this mindset that this is transitory, that somehow, yes, there's going to be a short-term effect, but we should look through it. And then the third thing we're not pricing in is there's very limited price very limited policy flexibility. We've been bailed out by policy over and over again, whether it was the Fed flooding liquidity or whether it was the fiscal. We don't have those degrees of freedom anymore. There's a real question mark as to what the Fed is going to do, and we're already running a 6% deficit. So the market hasn't quite realized that if this goes on, the policy offsets much less than what we've had before.